Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates. 10-year note yields still stuck in a range, although we did see a modest uptick today, just off the lows. Recall yesterday the trade talks and exaggerations and who can be bigger than who kind of had the market in a tuffle, and we saw bond yields drop, but today we saw them climb modestly, still in that 285 to 295 range where we've really been stuck since FOMC. And likewise, the big trade here is not going to be if we see a 296 or a 284 print. It's going to come on the heels of something north of 310. Well, I guess first we should get to 3%, but north of 310 or south of 275. Those are the levels we need to see in order for the market to really start to create a little anxiety, create a little momentum, because right now we're kind of stuck in this range as we get more data and as we wait and see how the Fed is going to implement its next round of policy tightenings, likely in September and December. And if you look at volatility, market volatility that is, it's actually been kind of trending lower again. We saw a very, very modest uptick yesterday when the market kind of got scared. And usually we see it go up dramatically and come back down quickly. We didn't even see that yesterday. So right now the market is starting to take notice of these movements in the in per se for volatility speak. And we're staying inside those comfortable ranges. The market's not getting excited about seeing a breakout move either way. And likewise, with all the leverage funds holding onto their shorts, as the market continues to normalize or see yields creep higher again, everybody's going to hold on and wait for higher yields. And that's pretty much where the market is aimed towards, continuing to see the trade of pain as lower yields. So if we do see yields start to break out to the downside, we should see volatility bid as well. And lastly, let's look at what we had today. Powell spoke from Portugal along with several other central bankers. And what he basically did was reiterated what he had said last week at the Fed meeting, something that, sometimes we get these meetings from the central bank heads after their central bank policy meetings where they're able to talk back maybe some of the hawkishness or dovishness of their tone or of their speech or whatever. We didn't see that. We saw him add on to that. So right now the market seemingly is adding on to the fact that, yes, the Fed sees normal rates maybe 100 basis points higher, which means continued rate hikes over the next year and a half. Likewise with the Fed, they see the economy very much a thumbs up. So look for yields to continue higher. Again, if something comes out of left field, it's going to be a geopolitical risk. It's going to be something that isn't in the script, and that will bid volatility and drives yields lower. Anything that pushes yields higher, I think, continues to see volatility decline and continues with the trend until we get to that 315 10-year yield, which we have not been to other than that one time earlier this year. So right now the bond market hovering back into that range that we've seen post FOMC, leaning towards yields going higher. Will they get the data they want? We'll have to wait and see. This is Todd Colvin coming to you from the floor of the CME Group.